Good evening, everyone, and welcome to yet another SuperStonk AMA. I'll be your fly-on-the-wall host today, while our guest host, Lucy, will be chatting to renowned economist Dr. Robert J. Shapiro. So thank you both for taking the time to join us.
It's 4:30, which means it's time to grow a wrinkle or two and begin our next SuperStonk Ask Me Anything. Like previous AMAs, you provide the questions, we provide the platform, and our guests provide the insight. If you'd like to see these continue, please engage with our guests in a courteous manner and contribute to future discussions by asking questions in the announcement posts. So without further ado, let's get right into it.
All right, good evening, everyone, and welcome to yet another SuperStonk AMA. I'll be your fly-on-the-wall host today, and we have our guest host, Lucy, who'll be chatting to the renowned economist, Dr. Robert J. Shapiro. So thank you both for joining us.
It's a pleasure.
And I'm very glad to be here to talk to Dr. Shapiro. Dr. Robert Shapiro is the chairman and founder of Sonecon, a private firm that advises American and foreign businesses, governments, and nonprofit organizations on economic and security-related matters. He was the principal economic advisor to Bill Clinton in his 1992 presidential campaign and to the president. Plus, he advised Presidents Clinton and Obama and senior members of their administration. Clearly, Dr. Shapiro is part of the American economic establishment. That's why his challenge to their economic orthodoxy on naked short selling is so important. Dr. Shapiro, how did you get involved in the issue of naked short selling?
Well, the truth is, it kind of took me by surprise. I had just opened my advisory firm, and I was approached by 3 lawyers from Texas who explained their view that naked short selling, which is to say, selling shares short, but never borrowing or delivering those shares, was a widespread phenomenon, and it was being used to manipulate stock prices. The truth is, I responded that I was very doubtful, because if this was a large phenomenon, I would think I would have heard about it. You know, I follow the literature in finance, and there was really no literature on it at all. And they said, well, I'll tell you what's your hourly fee? I have to tell you, I thought, gee, what do I say? No one's asked me that before. And I came up with a number, and they said, fine. You research it and take as much time as you want and come to your own conclusion, and we'll pay for it. I said, that sounds great. And so I began to look into it, and I began to examine the short selling in small NASDAQ technology stocks. And I began to see a pattern, and the pattern was that these stocks would be going along fine, and suddenly the shorts against them would skyrocket. Many of those shorts were fails to deliver, or naked shorts, and the stocks would plummet. And I looked into a particular form of stock manipulation, which was called a bottomless convertible, or a death spiral financing, in which people came to small companies. They said, we'll put 15 million into your company, but here are the terms. If the price of the share declines over the next 6 months, then you make us whole by giving us more shares. And then there'll be another period 6 months later where this happens again. And we'll give you, and then like a day before it was supposed to close, they'll say, well, we'll give you $1 million now, and we'll give you $5 million at that first threshold, and then the rest at the second threshold. And then what they did was massive naked shorting in those stocks. The stock price went down. They got more shares to quote unquote make them whole, which they used to cover their original shorts. And then they shorted again until often they shorted the company out of existence. I looked at one syndicate that had invested in 350 companies. And it showed that within 1 year, 345 of them had declined. And the average decline was 65%. Well, that tells you, whether you're an economist or you just play the market, that tells you that they're making money off the company declining in value. Otherwise, how do they keep on investing? Because they're losing. If it were on the up and up, they'd be losing all their money. And so I became persuaded that, in fact, this was a serious phenomenon. At the time, the only place that really had the records on this was an organization that's called the DTCC, which is the Depository Trust and Clearing Corporation. That's a private company that's owned by the big financial institutions and which clears all stock and bond trades, or almost all stock and bond trades. And they refused to release any records on any of these companies. But they kept on saying this is a minor phenomenon, and it's really just about when naked shorts happen, it's really because they can't, because these shares have been lost in the mail, and excuses like that. Well, that was patently untrue, since even at that time, in the early 2000s, 98% of all trades were done electronically. There is no transfer of paper shares anymore. Well, finally, the SEC sent its own economist into the DTCC and said, you have to open your records to her. And she established that the DTC had been lying, that in fact this was a phenomenon that probably entailed on any given day about 500 million shares. Moreover, it was highly concentrated in about 20 or 30 companies at any one time, which is to say that's enough to move the prices of those shares, of those stocks. And that meant there was widespread or significant stock price manipulation occurring through naked short sales. So that's how I got involved. And I've been involved ever since.
Did you get involved with any of the early cases that the Texans, Wes Christian and the others did?
Yes, I did. And I became the damage expert for those cases. That is, I'm the one, I would figure out how much damage had occurred to the company. The damage comes when, these companies, the stock is falling, so they issue more shares because now they can't go to a bank because their price has been declining. And so they issue more shares, but they're issuing it at artificially depressed prices. So they get harmed. The law says that the damages have to come from selling shares. And so the damage to the company can only come legally when they issue new shares. And so I would figure out how much of the decline in the share price could be directly attributed to the defendant's naked short sales. And it's actually a pretty complex issue because the naked short sales signal, they appear to the market just like regular short sales. And so if an investor sees a big uptick in short sales against a company, that's a signal to sell your shares or to short yourself. It injects information into the market that people interpret as saying, wow, somebody knows something about this company, and there's large scale short selling of this company. And the reason that signal is so powerful is that if it were a legitimate short sale in a company that had a lot of shorts out against it, in order to borrow the shares to sell short, a legitimate short seller would have to pay a big premium to locate and borrow those shares because they're in short supply because there are already so many shorts out against it. And so the market says, wow, this, it's called the negative rebate. In order to short, somebody is paying 25% of the value of the shares they're borrowing in order to borrow those shares. If I've got shares in that company, I got to dump them. And I'm not going to buy any shares in that company. So the impact on the share price is not only the direct impact of all these shorts, which is to say a big increase in the supply of shares being offered to sell, and supply and demand says that means the price goes down. But there's that direct effect, and there's the indirect effect of the signal it sends to the markets. And that's another form of stock manipulation, which is injecting false information into the market. The naked short sellers are criminals.
Getting back, because you raised the question of the stock loans, in the years to come, you would lock horns with the SEC. And one of your earliest attempts was to get the SEC to act on the stock loan issue. Tell us about that and how stock loans play a role in naked short selling.
Well, it's really fascinating because, I published some analyses of what was happening in short sales. And after the SEC issued the report from the economist who'd gone into the DTCC, they said, well, we need to we need to look again at the regulation of short sales. And the regulations hadn't changed since the mid-30s when the regulations were created. And so they called me in and said, what do you think? What does your evidence show? Give us some advice. I said, you have to discipline these naked short sellers by creating a system in which they bear an economic cost if they do this. And they take a real risk of losing a lot of money. And they came up with a regulation. It's called Reg Show, which set up a kind of complicated structure of if you had a stock that had very large fails to deliver and they weren't covered in a certain period of time, then the broker who would handle that could not sell short any more shares in that company. So it was not really a discipline on the naked short seller. It was a kind of signal, gee, you can't trade in that stock to a particular, to Goldman Sachs or Merrill Lynch or JP Morgan. They also, however, grandfathered all the existing fails to deliver. And so all these companies that were being destroyed by naked short sales, the SEC wasn't touching. And I went to them and I said, you've got loopholes in this that the short sellers will drive through. This is not going to affect it. And they said, well, we don't want to trigger what are called short squeezes. A short squeeze is when you've got a short seller and the price starts to go up instead of down. And when that happens, the short seller has to put up more money in order to maintain his short position. So they get squeezed. And if you said you've got to make all your naked shorts real, the only way they could do that would be to go into the market and buy the shares. And that would send the price of the stock up and there'd be a short squeeze. And they said, well, we don't want to have a short squeeze. And I said, look, short squeezes are the way the market disciplines bad behavior. That's exactly what you do want. And otherwise, you're not going to have any effect on this. And, the SEC, it has its constituencies, and they don't include little companies being attacked by criminals. Mm-hmm. They include the big financial institutions and the big companies, so they didn't do anything. And in a year and a half, it was clear that the rule had no effect. They came back and they said, well, what can we do? I gave them more advice. They took about half of it, and it improved things a little, but not much. And then they finally put in place a rule that has some teeth. It's got like one row of teeth. It's got top row, but not bottom row. And it has, over time, moved the effort to manipulate stock prices through short sales from the kind of direct route that naked short sales represent to more sophisticated and esoteric instruments where you buy and sell options and puts, and you can have the same effect. Or you carry it out in what's called X-clearing, which is trading between financial institutions that doesn't occur through the regular markets. X-clearing means it's not cleared by the DTCC. Mm-hmm. And so it has continued, but not as bad as it was. It was the Wild West. And it was always illegal, but never prosecuted. Mm-hmm. And so you had what you would have in any industry. You have bad actors and good actors. You have people who obey the regulations and laws and people who don't. We saw that, for example, in health and safety regulation at the beginning of the pandemic, and how certain pork and chicken producers didn't follow the regulations, and others.
Let me ask you about one of your next confrontations or meetings with the SEC. An interesting story. It was a year after the 2008 financial crisis. You went to see SEC Chair Mary Shapiro and talked about naked short selling and its role in the financial crisis. What did you tell her?
Well, I had looked at the data around the financial crisis, and what you saw was that in the 2 weeks leading up to the total collapse, which was the collapse of Lehman Brothers in early September, the shorts against the major financial institutions increased fourfold, and the naked shorts against those institutions increased 50-fold. Half of all the shorts against the financial institutions were naked shorts. And what I said to Mary Shapiro was, look, these data, look, Lehman Brothers, Merrill Lynch, they were going to go down because the companies were bankrupt. But the naked shorts, this massive piling on of naked shorts, brought those companies down within a very short period of time. And the impact of the collapse of companies like that, if it happens suddenly, is very great to the markets, because the markets don't understand it and they kind of freeze up and they say, what's happening? We don't know where everybody else is. Had there not been any naked shorts, they might have been able to handle those bankruptcies much as they did the GM bankruptcy and the Chrysler bankruptcy, which was in a very orderly manner. What they could have done was go into all the financial institutions and say, okay, we're examining your books, and then publicly say, okay, these are the companies that really are no longer sound, and these companies are sound. And for the unsound ones, we are taking over a bankruptcy process. If you had done that, the Great Recession would have been a normal recession. We would not have had this terrible financial crisis. Now, that wasn't the only factor, but that was certainly an important factor. So I said that to Mary. She said, you're right. We have a hearing next week. I want you to come and make that case. And I said, certainly. So the hearing day comes, and a crew of five economists are there. Four of them are saying, and the issue was what could have been done about the financial crisis. And the other four were kind of traditional neoclassical economists, and they said, the markets are never wrong. This is, there's nothing you could have done. This was built-in distortions in the market, and you needed to let it play out. And I said, well, this was not a natural market phenomenon. The fact is there was irresponsible behavior in the derivatives market, those mortgage-backed securities, and which were whose ratings were corrupt. They were rated as AAA when they were all junk. Moreover, there was bad behavior in the credit default swap market, which was the insurance for these mortgage-backed securities. And you had massive naked short selling, which created the crisis, the sudden crisis. And I was explaining it, and the head of the staff head of the enforcement division, who had written the reg show, or was in charge of writing the reg show rules, and who I had tangled with previously when I said your rules aren't going to work. He was in charge of this hearing, and I was literally in the middle of a sentence, and he said, your time is up. And he turned off my microphone. He would not allow the full case to be made. And unfortunately, Mary Shapiro wasn't there that day. I did go in and speak to several other commissioners. But this is a very difficult problem. And the reason it's a difficult problem is that the economic incentives are so enormous. That is, you can make so much money in a way that, while it's criminal, there is almost no economic risk. I have this saying that the difference between the people who do this massive naked short selling and the rest of us is that the rest of us are willing to take economic risk, but no legal risk. So we invest and we hope we make money, but we take the risk that we don't make money. But we do it legally because we're not going to take a legal risk. The difference is these people are willing to take legal risk, but no economic risk. And the fact is that this kind of fraud is designed so they can't lose.
Now, as you were trying to get the SEC to deal with naked short selling, you were being denounced by the DTCC, the Depository Trust and Clearing Corporation.
Yes, I was.
And so they were, of course, they don't, I was going to say they settle stock trades, except for the increasing numbers that go ex-clearing that are settled in the big broker dealers between their own customers. But why did the DTCC attack you?
Well, they attacked me because I was drawing attention to two things. One was that they had allowed large-scale stock manipulation to occur, and which they covered up through their procedure, which is if there is a naked short sale, what the DTC does is it goes into the reservoir of all the shares in that company, which it's holding, and it covers it and says to the naked short seller, well, you owe us this, you owe us the shares, but it doesn't make any effort to collect them. Now, why? Because the second biggest source of revenue on Wall Street is lending shares. The fees that Goldman Sachs and JP Morgan and Bankers Trust, that they all get from lending shares, and the only use for lending shares is short sales. When they carry out a naked short sale, sometimes they don't tell the short seller that they never covered. So they get the fees. They don't have to pay the additional costs. It's an enormous moneymaker. And if they're doing naked short selling for their own accounts, which they were doing, some of them, then they also get the enormous profit. And so, we're talking about billions of dollars here for these companies. And that's a very large incentive. Mm-hmm. Let me say there were there were a couple of them which were regular bad actors and others who were not. So there is some of the great names in American finance are pretty close to being criminal organizations, and some are not.
You have said that the people in the SEC, the SEC is in bed with Wall Street.
Yes.
So, and the DTC, of course, is owned by Wall Street. It's owned by the big broker dealers. So can you talk a little bit more about that? I mean, this seems to be taking regulatory capture to great extremes.
It does. And one of the ways is that the SEC, part of it is, SEC staff, there is a regular revolving door between being on the SEC staff and then going to work for a big either secure Wall Street law firm or a big Wall Street financial institution. That's not limited to the SEC. That's now true of White House staff and senior congressional staff often. Not always. Again, there are some people who are in it just for the money and other people who are in it for public service. And so, that's an incentive to please your prospective employer who's going to pay you $1 billion or $5 billion as opposed to, the 200 grand you're earning from the government.
Um, now let's talk about GameStop and how the market manipulation, including naked short selling, played a role in the share spikes and drops, and the role of the hedge funds. You wrote about this in detail in the Washington Monthly in February.
Yes. Well, it was a very, as soon as this broke, and the common line was, it's these small investors, on Robinhood and organizing on Reddit who are driving up the price of this company. Well, I looked at the stock price, and the stock prices, had gone from 15 or 20 to 400, and then they would fall to 200, and then they go back to 350. And I asked myself, okay, when the stock is at those kinds of prices, who can afford to buy and sell large blocks of these shares? Because, they were hundreds of millions of shares were being traded every day. Well, the small investors on Robinhood don't have the billions of dollars that involves. The only people who have that are institutions. There are lots of institutions, but most institutions have fiduciary responsibilities. Institutions like pension funds and bank trust departments, who are very big buyers and sellers in the market. They comprise more than half of all trading in the market. And so I said to myself, who is not subject? What institution is not subject to the fiduciary responsibilities? And the answer is hedge funds. And they have the resources, and they can do whatever they want with them. Moreover, there are, hedge funds are organized to move large blocks of stock in and out of companies quickly, which was what we were seeing. And so to me, this looked like a battle between hedge funds. The hedge funds on the short side and the hedge funds on the long side. Mm-hmm. And that's why it kept going up and down and up and down. And so it was a battle of billionaires that the small investors and the small investors from Robinhood, they were just collateral damage. Well, again, the short side of those, at times the shorts were 50, 60, 70, 100% of the outstanding shares. Well, whenever you see shorts, the outstanding shorts are equal to more than about 10 or 15% of the outstanding shares, you know that it's become very expensive to borrow the shares because they're in short supply, because you can't borrow shares from a regular investor, from the account of a regular investor. All the shares which are borrowed have to come from the accounts of institutional investors. That's to protect the small investor. So if you've got these massive shorts, it's very expensive. And if it gets over 50%, there are no shares available to borrow. Mm-hmm. Because the institutions hold 50% of the shares, and you can't borrow from the other. So, this is arithmetic. It's not complex math. So we knew there was massive naked shorting. That was again manipulating the price of that stock.
Where are the numbers that anybody could see? The numbers that are public that will back up what you're saying.
Well, the number of shorts outstanding on any company and the number of shares that are available to buy or sell, which is called the float. It's usually less than the total outstanding shares because founders and so on hold shares that can't be traded normally. So they're in the outstanding shares, but not in the float. And companies always keep a certain percentage of their shares not in the market. So if for some reason they want to expand the number of shares, they can pull those shares and trade them. All that is available at Yahoo Finance for anybody to see, for any company. The data on the holdings of institutions versus non-institutions, most companies, the basic financial information about most companies will also include the percentage of their shares held by institutions. And again, those shares cannot be borrowed for short selling under SEC rules. So you could get all those data and just do the arithmetic.
Now, the SEC chair, Gary Gensler, said in London recently, I think we can bring more transparency to short selling. We have unused authorities in that space that were granted by Congress nearly a dozen years ago. So based on everything you have said here and what you know, what should Gary Gensler be doing now?
Well, let me say first, I know Gary quite well. When I was Undersecretary of Commerce, he was Undersecretary of the Treasury, and we were each represented, our department's representatives to the board of the Pension Benefit Guaranty Corporation, which is the organization within the government that takes over failed defined contribution pension plans if the company goes bankrupt. So it's actually the only part of government that holds stock, actual stock. And so that's how we got to know each other. And he's a person of great integrity. He tried, when in the Obama administration, he was head of the Commodity Future Trading Commission, and he tried to tighten the rules on derivatives, these derivatives like credit default swaps that can be used to manipulate markets or to get windfall profits for financial institutions or windfall losses, which was what happened in the financial crisis. And he got a little of it, but not most of it. This is someone, I think, who really is committed to protecting investors, regular investors. And the first thing he can do, the most important thing he could do, is start referring cases of stock manipulation through short sales to the Justice Department for criminal prosecution. The fines are a mosquito bite. When J.P. Morgan Chase was found to have fraudulently assured its clients that some block of mortgage-backed securities was sound when they knew it wasn't. This is the biggest financial institution in America, and this was the worst financial crisis in 80 years. The fine was equal to, I think, 7% of 1 quarter's earnings, right? And that was for a terrible thing, but no criminal prosecution. People who think these institutions believe that they can get away with anything because they have gotten away with anything.
Mm-hmm.
And so the strongest signal he could send would be to urge the indictment of senior executives of companies that have been found to do this on a regular or repeated basis.
Mm-hmm.
That's something that will get their attention. Everybody, people on Wall Street figure, I lose somebody, I'll make more. The kind of dirty secret is that all these institutions make what economists call oligopoly rents, which is to say, the reason they make such enormous amounts of money is they control the market. There are a couple of companies dominating the market and a handful of companies. And that allows you, while the rest of the economy, is the return is, 15 or 20%. The return for them is 50 or 60%. I remember when I was in government and there was the Clinton administration was pursuing antitrust an antitrust investigation of Microsoft, and I was in a meeting in the White House, and Microsoft's earnings had just come out, and I said to the president, "You want to see what monopoly or oligopoly returns look like?" I said, "Here's Microsoft. Their rate of return this year has been 45%. I said, "You cannot do that in a free market."
Mm-hmm.
And these institutions in finance, tech and finance are the two of the most highly concentrated sectors in the economy, and they both happen to have by far the highest compensation for everybody at the top. They're making tens or hundreds of millions of dollars a year. Well, they're not doing it because they're not getting that because they're smart. They're not any smarter than a guy running a small company or most doctors or most journalists.
Mm-hmm.
They have special skills that they've learned, but that still does not explain, from an economic perspective, this enormous disparity in compensation.
Now, the House and Senate Financial Services Committees had hearings earlier this year, and they barely mentioned short selling. Nobody mentioned naked short selling. What should Congress do?
I think that, well, look, Congress, in its defense, the oversight function of Congress right now is there's not much bandwidth left, right? We've got not only all of the terrible acts and crimes of the previous administration, we also have all these issues around the handling of the pandemic, the handling of all the money that's been spent to address the pandemic. So the oversight plate is pretty full right now. At the same time, I think what Congress should do, if I were advising them on this, I would say direct the SEC to investigate these particular questions, and you could also set up a commission to look into the impact of domination in the financial system and the impact of criminal acts by those actors, and get set up a commission of, a blue ribbon commission, establish the basic facts. That's what they can do.
Now, we have some questions from people who are members, and they would want to put them to you. And one of them says, and you raised one of these questions before. He said, ask him about more about his knowledge of shares failing in X clearing. I pointed out that about 40% of GameStop trading happens in dark pools. OTC, non-exchange trading for GME, GameStop, has exploded since January. And is X clearing a way to let trades fail outside the DTCC and official SEC failure to deliver statistics? What happens with X clearing fails, and how can we put pressure on regulators to make Reg Show apply to all trades, including X clearing, and establish fairer, more transparent markets?
Well, X clearing, these dark pools, what it really is its origin was you would have an institution that wanted to sell a really big block of shares in a company, but they couldn't do it if they did it in the normal process. Dumping that many shares in the market would depress the price, and you could cause a spiral down in the stock for a while. It would recover once that was over, but mainly the people selling the shares would have to sell them for a falling price. And so this arrangement, so what they allowed was, if one institution can cut a deal with another institution and say, all right, I want to sell 500,000 shares of this stock, and it's right now trading at 40. I'll sell it to you at 38. And we will do this as a private transaction. And 38 is a bargain for the buyer, and it's a good deal for the seller, because if he tried to sell that many shares on the open market, the price would probably, could fall to 35 or 34. So they said, well, okay, that's reasonable, because it maintains the stability of markets, which is, the golden rule for the SEC. Maintain stable markets. That's why they didn't like the short squeezes. It was used not very often, because how often are these big block trades occurring? But once they began finally cracking down on making it much harder to get away with large-scale naked short selling, which took them about a decade from the time they began the process, naked short sellers looked for other ways to carry it out. And so there is now a lot of short selling which is not covered in the X clearing market. And the fact is, it does have impact on the stock price in the regular market. And what can we do? It seems to me that you could have a way to trade very large blocks of shares without dumping them into the market, but in a wholly transparent way, in which there would still be cleared. It would just be cleared in kind of a different section of the SEC, of the DTC.
But now the rules say that fails occur in trades that are settled by clearinghouses, by recognized clearinghouses, meaning if they're done through dark pools, they're not even under the rules of the SEC.
No, they're not.
Shouldn't they begin by changing that any trade that fails is a fail, and
Yes.
it has to come under the same rules? That they gave them an escape route.
Absolutely. I mean, it's not that they're not under the rules. It's that the SEC says, okay, you're under our rule, but you don't have to follow this rule if it's done excellently.
Well, yes, that's the point. You don't have to follow
so absolutely, a fail is a fail. And again, we're not talking about an occasional, fail of 100 or 500 shares. We're talking about fails of millions and tens of millions of shares that are sustained for days, weeks, months.
Well, it would appear that a lot of these fails went through dark pools. The GameStop fails, a lot of them must have gone through dark pools, because the statistics that have been put up show that a large proportion of the trades went through dark pools. There were so many fails. You put them together, and it seems to me, shouldn't that have been looked at by the SEC?
Yes, of course it should. And again, the most powerful thing they can do is establish it and then refer it for criminal prosecution.
There was a question about that, which you have already answered. What should be done? The fines are so minuscule. Now, what would it take? What kind of systemic change is necessary to prevent the rampant abuse of the system beyond what you have already suggested?
Well, one thing we need to look at is the concentration in the financial sector. Now, this is, right now there's a lot of attention being given to the concentration in tech. And the ability of companies like Google and Facebook and others, they're the kind of best known, but, companies like Oracle, there are a lot of companies that dominate a piece of the market enough to manipulate it. I suspect I suspect this is also the case with parts of Amazon. It's certainly the case with cloud computing. Well, it's also the case on Wall Street. And, we do have a new set of people at the top of antitrust, both in the Justice Department and at the Federal Trade Commission, who are very interested in reducing concentration, which is the first time we've seen that in decades, frankly. They are focused more on tech than on finance, but I think they need to look at finance as well. And, the question is not just, are they going to be broken up or their ability to buy more companies limited? It's that they know that they're under scrutiny. They know that, these are government agencies that have the ability. The Justice Department can come in and look at anything they want in the midst of during an antitrust investigation. And indeed, particularly in finance, I mean, it's more true in finance than in tech, because the financial institutions are also regulated by the Comptroller of the Currency, and the Federal Reserve Board, who also have the ability to go in and look at any record they want. So what you need is a Fed and a Comptroller of the Currency committed to an honest and free market in finance, which we don't have. And it's, transparency is a very powerful tool. And if only because transparency raises the possibility of class action lawsuits, if as well as perhaps criminal prosecution. You got to put, I think these people are beyond the fear of God. I think their behavior shows that. But you got to put the fear of something into the highest levels of finance and all the trading desks in finance.
Yeah.
In order to begin to see real change.
Well, suppose going forward, suppose there was another big spike in GameStop or AMC. Is there something that the SROs, the self-regulating organizations such as FINRA and the SEC, if there's a violent price shift, should they have acted quickly instead of basically, I could see doing nothing? Because is there some systemic risk posed by that kind of event, or is it just a one-off thing that doesn't really matter? Did they miss something?
Well, when it comes to a stock like GameStop, there's no systemic risk because it's a small company that is not connected to basic parts of the economy. But there may be it could be used to investigate whether there's a systemic problem. That is, whether what's happened to them is happening at some level to lots of other companies, and which does create a systemic risk.
Yeah.
But what you need for any of that, and what is very hard to get in the midst of a crisis or a big shift in the market, is the clear information about what's going on. We really can only regulate in retrospect areas that we haven't regulated before. Now, once we find it, we can set in place new regulations, and then the SEC or FINRA could step in as soon as they saw any evidence that looked like these previous cases. But it's, finance is so big. It involves so many trades. You're talking about, billions of trades involving tens of billions of shares, sometimes being done in very complex ways. And how does a enforcement staff get their hands around that problem? Well, they can really only do it once all the data are there and they can actually get access to.
Maybe once also there is some attention paid by other interests. For example, you are from your past have a lot of connections to the Democrats, who are now more or less in power in both houses. Do you talk to any of the people there that are concerned about these issues? Do you talk to them about the naked short selling? What do they say about what's going on?
Well, actually, yes, I have in the past. The fact is, right now, this is not a front burner issue. We're in the midst of a terrible pandemic and huge economic distortions. As a result of it, we had a seditious attempt to overthrow the democratic process We have lots of attacks on voting rights. So these issues are not at the top of most people's list of things to do. But there is interest, and that's why I say, one thing we could do is, the SEC, which has no role in any of these other issues, can begin to ask what behavior warrants by financial institutions warrants a criminal investigation, and why I suggested that a blue ribbon commission to investigate this and establish the facts, get access to all the data and establish the facts, and then Congress and the administration can take serious steps. It's we have to remember that the U.S. economy is still the most important economy in the world, and our financial markets are the most important financial markets in the world. Everybody is affected by terrible distortions in it. So you don't want to make a big mistake. So establish the facts first. Get transparency, establish the facts. Then you can have serious structural and systemic change.
I think that's a good place to end it. And I want to thank Dr. Robert Shapiro for being on this SuperStonk AMA and said things that a lot of us, including me, found quite fascinating and very important. Thank you. I'm Lucy Komisar.
My pleasure, Lucy.